this is Meg Grosso with the Meg Grosso Group of Berkshire Hathaway. Today I am here with Steve Zechman of Homesale Mortgage. That is our in-house lender. And Steve has been in the lending business for 14 years, and he's been with our mortgage company for the past 8 years. He is a wonderful wealth of knowledge, and I brought him in here today because we had some questions from some buyers. And Steve, thank you for joining us.
Thanks for having me.
Yeah. And so today, my question is, oops, wiggling there. My questions are today, I had a buyer who she's just getting started. She's buying her first home on her own, and she's been very good and diligent about checking her credit score and making sure that she stays up with it. And when she checked it, she found out that she had what she thought was a really good score. But when she went to talk to a lender, they told her that it was different, and she wanted to know why. So can you give us a little explanation on that?
So lenders, whether it be auto, mortgage, banking wise, when somebody runs your credit, we're paying for that service. So, or the client ends up paying for that service. There's different types. There's the Vantage score, and then there's a FICO score. Vantage score was, the algorithm came up, I think it was 2006. I don't know any places that use a Vantage score, mortgage or auto, but one of the places that uses Vantage scores is Credit Karma. So I think Credit Karma is a good place to monitor your credit, for inquiries, delinquencies, something pops up, it's going to alert you. But when it comes to credit scores, they're going to be different than what, say, I am going to pull. I'm going to pull all three credit bureaus, Equifax, Experian, and TransUnion, and then we're going to take the middle score of the three, because each one has different things on it. One may have a collection on it where the other one doesn't. One may be reporting 15 trade lines where another one only may be reporting 12 trade lines. So that's why we take the middle.
And are you taking the average of the three or the middle score?
The middle score.
Okay.
The middle score. So we throw out the high, throw out the low, and take the middle.
Okay.
So the Vantage scores, like the Credit Karmas, that's where we get all the questions from. Why is my score different from Credit Karma versus when you ran my score? And really it's because it's looking at different things. So they're using a Vantage score model. They're looking at typically the credit card part of your bureau. If you have lots of credit cards and low balances, you're probably going to get a much higher Credit Karma score. But when we look at it, our models, our algorithms are looking for, past mortgages, maybe even car loans or a big revolving type things, personal loans, that kind of thing, where we're looking at collection accounts. Even if they're small, they're still sort of hitting you, where Credit Karma and the Vantage score may not be counting that in. So that's why the differences are.
Okay. And why are they using the different credit scores? I know I've heard that store cards use slightly different credit numbers than what a vehicle purchase or a personal loan or a mortgage. Is it because the mortgage is such a large sum of money that they drill down a little bit more?
I mean, I can only tell you from my experience, like when I was in the car business, when we pulled credit, typically we pulled one credit bureau. It was TransUnion. So TransUnion may have a lower score. It may have a higher score compared to the other ones. It all depends on what's reporting. With mortgages, we run all three. Okay. So we're not just focusing on one, because you may have one, like Experian, maybe 40 points higher than what TransUnion is. And if they're using that Experian, obviously you're going to be 40 points higher. So mortgage-wise, that's why we use that middle one to throw those types out.
Okay. And what's the best, most reliable source for checking your credit? You mentioned Credit Karma. What would you recommend if somebody is really looking to purchase a home and get themselves set up? What's the best source that they should use?
So obviously Credit Karma, I think, is free, right? So
I
you go
believe
in
so.
there and
Yeah.
get free.
Yeah. It's free.
So,
And I think you can dive down into a more
right. So, the old saying is nothing comes for free, right? So,
true.
the best probably source for a consumer is to go to the TransUnion website. I think it's transunion.com. And you can go on there and you can buy credits. So you can get your reports and you can also buy your credit score for each bureau. So you could
Okay.
get TransUnion, Experian, Equifax, and then you have it all right there in front of you. Which one is reporting this? Why are they reporting that? Some credit cards, some collections, whatever. But that's going to be your best bet. You're going to have to pay for them, whatever they charge, $9.95 or whatever it is. But if you really want to get a sense of where your credit score credit is to do that.
Okay, so it's a good investment, especially if you're looking to purchase a home in the near future, to spend the extra $10, $12 that the credit bureaus are charging so that you can keep track of that score.
Yeah, I mean, you're going to get a rough idea with Credit Karma. I mean, if it's showing you in the low sixes or something, it's going to give you an idea. You're probably a lower credit score.
Okay.
But sometimes when I run people, they're saying they're a 650 and I run them and their mid score is a 500. Right. So it can be really wacky. So your best bet, if you're in that, I mean, if your Credit Karma is showing you an 800 credit score, I probably wouldn't worry about it.
Okay.
It's when you get into that lower tier, you may want to buy and check out all three and see what the deal is.
Okay, great. And what was my next question? I kind of forgot there for a second. If you're applying for a mortgage, if I am the consumer and I check my credit score on my own, is that going to ding my credit score?
No, not if you check it on your own.
Okay, but if I have a lender do that, will it ding it? And how hard does it ding it?
So I get this question probably more than any of them. If you have good credit and let's just say you're over a 700 credit score and I am going to check your credit for mortgage purposes, more than likely it's not going to affect you much. The lower the credit score, the more that's going to affect you. Like, I would be worried if you tell me you're a 630 credit score, and because I could check your credit, now we could be a 615 or a 620 or, sorry.
That's okay.
But if you're a 800 credit score, you're good to go get your credit run. So it's not going to affect you as much.
Okay. Now, if I am a consumer and I have a chunk of money sitting here and I'm looking to buy a home, but I have some credit card debt or I have some car loans or some student loans, which would be better for me? And of course, I know the big word is it depends.
Right.
But if I had that, say I had $10,000, do I want to save that for my down payment and my closing costs, or would it be better to possibly pay down my debt, especially if I'm in a 650 to 680 credit score? Should I pay down my debt, and which debt would be better to pay down than others?
So if you're asking me that question with a 650 credit score per se, I would say, number one, it depends.
That's always the word.
Before they did anything, I would want to take a look at their credit.
Okay.
So, because then I can sort of, if they're a 650 and maybe we want to get them to a higher credit score for better rates, better product, whatever, I can run it through our score scenario and see what would be better to pay off, whether it's pay down that credit card down to a certain balance. Student loans, typically, we're not paying those off because usually they're massive to begin with. But your revolving credit, your credit cards, car loans, typically you're not paying off unless you have a really small balance. But to look at that, I would rather look at that and then tell the client, hey, you're good. We'll use that for down payment, or hey, let's take some of that and pay this off or pay this down because this will give you a better product. So that's my answer to that question.
Okay, good. So it's a good conversation to have with your lender to
Yeah.
reach
Yeah.
out to ask those questions.
I wouldn't just go off and do it on my own. If you're looking to buy a house and they say, oh, hey, I'm going to pay my credit card off because they've always thought that paying your credit card off is the best thing to do. Then they go pay it off and they close it, and I go run their credit. Now they have worse credit, or their credit got dinged because they did that. So, yeah, talk to your mortgage guy first so
Okay.
that they can sort of walk you through all that.
Okay. Now you brought up a really good point there. If a buyer or consumer, they pay off their credit card, should they close that account or should they keep it open?
I'd keep it open.
Okay. Why is that?
Well, once you close it, it closes out that line. So there's no, you don't have that big balance, whether it's $3,000 or $5,000, showing that you have that buying potential to go out there and spend. You have a $3,000 limit. Now you have zero because it's a closed line. So that can affect, depending on how big your credit bureau is, how many years you've been in it, paid stuff off. That could hurt you worse than just leaving that thing open for now.
Okay. Okay. After you get your mortgage, you can close it if you feel
Yeah,
the need.
yeah, yeah. Yeah,
Okay.
you don't want to, when you're going through that mortgage process, you don't want to do anything, even though in the back of your mind you've heard about it and yeah, paying off this or closing that, until you're done or you talk to your mortgage person and they advise you, yeah, it's okay to do this or it's okay to do that, because you can really screw yourself up.
Okay. Good advice. Excellent advice. So, and of course, as we always tell people, if you're looking to purchase a home, don't go buying a new vehicle. Don't go buying furniture and appliances on credit.
Right.
Keep your credit at a neutral level. So,
Yeah.
do you have any other advice or tips or tricks or words of wisdom that you can share with our consumers today?
Well, if you're getting ready or looking to go buy a home, and credit is maybe not an issue, but you're sort of, you don't know. Um, I, First thing you got to do is talk to. You don't want to get into the out working with Meg Grasso and you love this house and you want to do USDA financing or you want to do a PHFA loan to find out you can't, because of credit score, debt, whatever. So my advice is, before you're even, if you're thinking about in the next month or so, I'm going to start looking for a house, talk to a mortgage person, get everything laid out so that if there is something that needs to happen to get your credit score up or pay something off, you have a little bit of time to do that and you're not setting yourself up for disaster when you fall in love with the house and can't buy it.
Now, as of, let's see, 11/22 on May 11th, 2020, how are interest rates looking at the moment?
Interest rates are as low as I've ever seen them.
Okay, that's awesome.
Right, conventional wise. I mean, a 30-year fixed right now, you can get anywhere depending on credit, depending on what the price of the house or the loan is. I mean, anywhere from probably 3.1 to 3.3, somewhere in that general area with excellent credit.
That is fantastic.
Yeah, it's really a crazy environment right now, and I don't think that they're gonna. If they do go up, they're not gonna go up very much this whole year. So I'm thinking that we'll be in good shape for the year at least.
Still a good time for buyers right now.
Still a good time for buyers.
Awesome. And of course, you handle all of the types of loan: conventional, FHA, USDA, VA,
Yeah.
PHFA. So
Yeah, we can pretty much do it all.
wonderful. Well, you know what? I think for one of our next sessions, I think we're going to talk about those different loans and the advantages to them and everything. And
all right, cool.
And help everybody out. So Steve, thank you so much for taking the time today to come out and meet with me here on a Zoom meeting and share with the customers what their credit scores mean and how we can make the best of them. So
Thanks for having me.
Yes, no problem. We'll hopefully see you again here soon.
All righty.